Hi, I'm Victor Mpunga, Head of Research at Old Mutual Wealth Private Clients. Given that this was the Finance Minister's second attempt at presenting the budget, there were no real surprises. The big question coming into this budget was, will there be a VAT increase? And if so, what would be the magnitude of that increase? The answer to that question was that it's a 1% increase, but it will be phased in over 2 years. From a consumer perspective, this is obviously more positive, in the sense that we have more cash left in our wallet for us to spend. However, the other side of that, the fact that Treasury increased VAT despite some strong pushback that they've seen over the last few weeks, it shows how committed they are to continue along the path of fiscal consolidation, where every increase in expenditure is accompanied by an increase in revenue. Two things, though, that are very important from how this budget impacts an investment portfolio perspective. The first is around budget deficits and also the debt to GDP trajectory that was announced within this budget. From a budget deficit perspective, the number came in slightly worse than what was forecast about a year ago at about 5%. However, when one looks forward in terms of the forecast, or even if you strip out the interest component of that, what you see is that the numbers are actually pointing in the right direction. We are expecting some primary surpluses over the next few years, which is positive for the bond market. Closely related to that is the debt trajectory that we saw in the budget. So debt to GDP is now expected to peak in just about a year's time, although it is peaking at slightly higher than what was initially anticipated. Taken together, these lower budget deficits over the coming years and the debt to GDP peaking in the next year, both of those are positive for bonds and in turn positive for the currency. We're unlikely to see a significant increase in bond issuance, which again is very positive for the bond market. The second aspect, which was quite important in this budget as far as one's investment portfolio is concerned, was around infrastructure spend. Now, a lot was written and said by the minister as far as infrastructure spending is concerned. The figure that he mentioned was about 1 trillion that they expect to spend on infrastructure over the next 3 years. The majority of that is going towards transportation and logistics. They also mentioned the issuance of the first ever infrastructure bond, which will be very interesting to see how that pans out. I'm sure most will agree that there are many infrastructure gaps that we see within our economy that act as a constraint to economic growth. A clear example of that is what we see in the rail transportation sector. What remains to be seen is if this investment infrastructure spend is going to be well executed. We know the very strong link that exists between infrastructure spend and boosting economic growth. If we think of a lot of the companies that we invest in on our local market and that we are invested in our share portfolios, a lot of those are heavily reliant on the local economy growing much faster. Certainly the SA Inc. companies. If we're able to remove some of those infrastructure bottlenecks, we would expect a lot of the SA Inc. companies, particularly the industrials, to be able to see faster economic growth. So bringing it all together, we think that the announcements around smaller budget deficits in the coming years, the larger primary surpluses are positive for both the bonds and the rand. And then over the more medium term, if we see good execution as far as the infrastructure plan is concerned, that could have a positive impact on local equities, particularly the industrial companies that are more reliant on faster economic growth. The re-rating that we saw in some of our listed equities last year, if we get faster economic growth, can continue over the medium term. Thank you.